Hi everyone, my name is Ganesh Babu. So I have been a professional in financial industry, specifically in wealth management industry for last 11 years. So I would like to talk about capital markets today. So let us go to the presentation. I'll share the screen. Hope you all can see my screen. The topic we are going to discuss today is capital market. So I'm going to really go very fundamental about the capital markets. So because these are all generally these experts use lot of terminologies which the common man was not really able to understand. So today I'll try to break down and I'll try to make it as easy as possible for a common man to understand what is a capital market. So I'll start with some of these headlines. So when I talk about capital markets, right? So suddenly what comes to the mind is this finance channels and like media, like some big headlines coming. So I can read some which you can see. Sensex, Nifty fall as near-term inflation outlook spoils mood on Dalal Street. Okay, so honestly, a headline like this, when I used to read before I joined this finance industry or before I did my MBA, honestly, I didn't understand anything. Maybe I understand the word inflation in English, but like honestly, I don't. So look at this thing: IT stocks sink, dragging Sensex Nifty to flat close. Then again, share market highlights Nifty under 19,300. I don't know what is that word. Sensex sinks 0.6%. What it means, I don't know. Okay, so right now the election is going on. So if you look at it, poll fever grips D Street. So what are all these things? What is Nifty? What is Sensex? Why should I be worried? Of course, some of your investments which you have done are directly linked to Nifty and Sensex. But what is Nifty? Or what is Sensex? What is a capital market? So the idea is we are going to really take a look at the capital markets as what it is. Okay. So this slide explains you what are we going to learn for today. I told you we are going to talk about the fundamentals of capital market. Then I'm going to talk about a concept called price discovery. It is very important because whenever you see that Nifty falls or Nifty rises, they are all talking about the price of group of stocks. Okay, so when a price is going to go up or down, we really need to know why a price is going to go up or why a price is going to go down. So this concept of price discovery is very important because after you have invested, whenever the price goes up, you are going to get benefited. And the price goes down, you are going to get impacted. So why that is going to happen? Then how to understand the headlines. And last one part also, which is very important, I want to talk about. It is why are these capital markets first of all existing? Why to complicate our life, right? Like we can just go buy things, have our life. Why we have to know these difficult concepts, your derivatives, cash market, then forwards, contracts. Why there is a capital market? So this is what we are going to learn today. So before going to the capital market, so it's technically capital plus market, right? So what is the market? So, let us take an example, right? Assume you go to a vegetable market. Right? Like you want to buy a tomato, right? You want to buy a 2 kgs of tomato, just like that. So, what is a market? You can explain the market by the 4 points mentioned in this slide. So, for a market to exist, you need a buyer, okay? So, which is you in this example, which I'm going to quote. Then you need a seller. So you need somebody to sell the tomatoes to you, right? So buyer, seller, then goods. Tomato, right? Like you're going to buy tomato. So which is very essential. And the fourth thing is price. Okay. So what price you are going to buy tomato? Assume tomato is like 40 rupees per kg. Okay. So whenever these four things are there, it is called as market. Okay. And in and around us, there are so many markets. There are vegetable market, there are fruit market, there is a real estate market. Like, there are markets for like your dresses, your electronics, like, so everywhere, like, around us, what we see is like, we see market all around us. Okay. So for you to understand market, you need to understand these four parameters. This is very important to understand the market before you just like, go into understanding the capital market. Okay. So what is the capital market? Okay. I'll read two of the definitions I took online. Okay. One from Boyce White. Capital markets is where those who need capital come to trade with those who are not in current need of it. This can come in the form of long-term investments like corporate debt, mortgages, and government bonds. I'll come to that. So you look at the Investopedia definition, the venues where funds are exchanged between buyers, okay, what we discussed in the previous slide, just called capital suppliers, and sellers, okay, in the form of equity, securities, bond, or other financial assets. So technically, what we saw in the previous slide, the exact same thing is what we are going to do here. So there is a buyer, there is a seller. Okay, so who had excess capital? So assume you earn something and you like spend only a fraction of the thing which you earned. So the remaining money you have extra. So what will happen? You will become the capital supplier to the capital market. See, you have to keep this money, park it in a fixed deposit or keep it in your savings bank account. Whatever you do, you are becoming a capital supplier to the market. Okay. On the other hand, assume you want to borrow a loan, like, or like you are taking anything, then you are becoming a capital buyer of it. So here, as you see, like a previous slide, there is a buyer, there is a seller. The goods is capital. See, this is where the confusion comes. The money is the good here. Okay, like so what you are doing, whatever the excess money you are having, you are going to give it to somebody. Okay, and like you are going to give it to somebody at a price. So I'll come to the price later. So technically, what happens? You are like selling or buying excess money. Again, you have to buy the same money with some money, right? That because that's how market works. So what happens? You don't like do everything at the same time, like at the current point of time. For an example, you book a FD, you are selling your capital. So you are selling the capital for what? You are selling the capital assuming you are getting a promise that this capital will be returned with a specific like amount of interest after 1 year of time. So some kind of a, so generally what you do, you give the capital and you collect something called FD receipt, or like that is called a concept. So it could be a FD receipt, it could be a share, it could be a bond, it could be a debenture, it could be a forward contract. So why I'm taking from FD is everything, right? A stock or a bond, everything has a promise, same like a fixed deposit receipt. Okay, so what happens? What you are doing, you are giving your money today since you don't need it, with the expectation you will get better than higher than what you are giving it today. Okay, so this is what is a capital market. So the nature of like you if you want to take risk, you can give the money as a equity, okay, which is a share. You don't want to take risk, then you can give the money as a bond, like, which is a fixed deposit or anything. So you can, there are multiple ways to do that. But essentially, this is what it is. Okay, capital market means there is a capital supplier, then there is a person who needs capital. Then both of them get into an agreement. So there is a good, there is a price. Okay. So again, like what I was discussing you in the previous slide. So buyer of goods is the investor. Okay. And the seller of the good is a company or a issuer or a government or investor who wants to like buy the capital. Then goods, as I told you, is the share, bond, debenture, or derivatives. And the price, as I told you, depends on the risk with what you are taking. So you would have had some promise, like you would have promised a 7% return. You would have been like expecting a 15% return. Why I'm saying expecting is in a stock, there is no promise, right? It's always a probability of winning or losing. So this is what a capital market is. So hope with these two slides you understand what is a, this is not like something which is like way out of everyone's world. It's common, it's normal. A market is market, okay? Be it a capital market or a vegetable market. So four things are necessary. So next time, like whenever you assess any market, right? These four things are very important: buyer, seller, price, and the okay. So let me go to the next slide. So we have spoken about the capital market in a length. Now we were seeing the like earlier slide where I was mentioning about Nifty going up, Sensex going up. So I'll tell you about Nifty and Sensex. See, a simple Googling will help you to find that. Sensex is a group of 30 stocks. Okay, so whenever Sensex moves higher or lower, that is the combined movement of all the stocks. If it is positive, then Sensex will move higher. If it is negative, Sensex will move lower. Nifty is a combination of 50 stocks. Okay, just these two. So this is what I so for you to understand why a Sensex or Nifty will go up, our Sensex or Nifty will go up because the companies within the Nifty or within the Sensex will go up. So one of the such companies is Reliance Industries. Okay, they have a maximum weightage in both Sensex and Nifty. So I'll tell you why a share is, again, as I told you, it's a good. So why the price of the share are like will go up or down. Okay, so that is what I'm going to show. See, what you can see, this is the quote which you can get during the trading hours if you visit any of the you visit your any of your brokerage login, or like you can go to Money Control and see, or like you can go to NSE site and see. So it's called price quote. So I'll like no, maybe let me take so I'll show you as you can see the current price is 925. So below that there is an amount figure called 2.05, which says the price is up by 2 rupees for the day, which is 0.22 percentage. I would like to bring your attention to the right side, bottom quadrant. So if you can look at it, order book, right? So there are four columns. One is the buy quantity, buy price, sell price, and sell quantity. Okay, so when buy quantity, then there is a buyer for the Reliance share. So there is somebody who has entered an order that he is willing to buy 47 shares at a price of 925.25. Okay, at the right side, if you see, there is a seller who wants to sell his 77 shares of Reliance for the 925.30. Okay, at this point of time, like assume the seller gives up this 5 paisa. Okay, he says, chalo, let me change my order and make it as 925.25. Okay, he puts that order, immediately that 47 shares will get sold. Okay, and the price on the left side top 925, that will change to 925.25. Okay, this is how the prices change. Okay, so technically what it means, the prices change based on the supply and demand. Okay, see, this news article will attribute so many reasons, but this is how in market it happens. So if the buyer is willing to pay a higher price, the price moves up. If the buyer is not willing to pay a higher price, then the price goes down. Okay, it's as simple as that. And you know what? One very important thing for the market is you need a buyer and a seller to make a market. So what I mean to say is even in the first of the worst days for equity market. So take an example of March 2020, right? March 27th of March 2020. It was people were selling, everybody had no hopes on equity market. Even on that day, so when someone is selling, like many people have sold, there were someone who's buying in the market. Okay, so whatever, even in 2008 crash, right? When they said no liquidity, there were banks going belly up, or your insurance companies going belly up. So what happened? Even on that day, there was some buyer and there was some seller. So based on so what price they will buy, based on whatever outlook they have, the price will keep changing. So this is how a price discovery happens for one share. So like this, it happens for multiple shares, because whatever share you want to go, then you have to go and deal with the buyers and sellers in that counter. When you do this thing cumulatively for the whole market, Then they will use the measures like Sensex or Nifty to find out what is the direction of the market. See, that means like Sensex might be up, or two or three companies in the Sensex, the prices could be down. The other way is also possible. So this is how the price discovery happens in the market. So now again, I want you to go back to the older slide of like the headlines what you are reading. So whenever you read anything like that Sensex is going up, then the stocks within the Sensex are going up. And why the stocks are going up? The buyers of the stocks, for some reason, we don't know the reason. Could be right reason, wrong reason, we don't know. The buyers of the stock feel that they can pay a higher price to buy their stock. Okay. So this is unlike, if it is falling, then like opposite is true. The buyer is not willing to pay the price which it is quoting. He wants to pay a price lower than what the price is quoting. Okay. So I hope now so far you would have had a reasonably good understanding of what is the capital market and like why a Sensex is going up or going down. So this slide is like very close to my heart. Okay? So I want to make things simple because that's how I'll try to understand the work. Okay. First of all, why are we having a capital? Why should the stock go up? Or like why should the stock go down? Why should like so many people complicate lives? Why should somebody make a bet and lose money in stock market? Everybody you guys are thinking, a fixed deposit is there or something other. You can buy a land and like sleep happily. Why would somebody go and do the gambling? Okay, so I'll tell you what is the stock market? Why is the capital market important? Okay, and the first point which I mentioned, right, healthy capital markets is very important for the economy. You would have heard it, like you would have read it in a lot of the books, big experts will talk about it, economists will talk about it. But as a common man, why would a capital market is good for an economy? Like leave the economy, what is the capital market do? Or how can a capital market helps for a people like you and me who are like very small, who are like nobody, right? We are not that like big market taker. So capital market, look at the second point. So capital market helps in efficient capital allocation of the society. Okay, I'll read it again. Capital markets helps in efficient capital allocation of the society. So what it means, so some of you who are listening into to this video, you would have been working for some company. Okay, every company in the beginning of the year they'll do something called budgeting. Okay, so technically, what is budgeting? So, or like even government does best, right? So, what they do, they will have enough capital with them or like enough resource with them. They will be allocating that resource, correct? So, assume they want to invest say 100 rupees of money. So, which project to give money? So, how will they decide? They'll decide which project has a more probability of success, which project has a better return on the investment. So, like for a company, you guys do this thing. Government does it because government objective is not the return; it has a different objective. So, you people all different entities will do this thing, right? So, how does this capital allocation happens for the society? The society is a group of people. So, when a company, you have one owner, so he decides who to do. Like in a society, nobody decides, right? Nobody decides where the money has to go. Who decides where the which is the efficient way or which one would have a higher probability of success or which investment can give a highest return? Who knows? Nobody knows. So then there comes the wisdom of the crowd. There your capital market helps. So nobody knows which project will give, but the people will keep on betting. Okay, they'll say Tesla will do it. They'll say Apple company will do it. In India, if you take, they'll say HDFC Bank will do it. ICICI Bank will do it. People will go find more information. They will read more about it. They'll talk to people. They'll keep on making a bet, and this wisdom of the crowd helps in efficient capital allocation of the society. I'll also tell you why the capital allocation is efficient. I'll come to the point later. Then the other point is helps in progress of any society or country. So as I in the beginning of the slide, as I told you, So how does it help a common man like you? Efficient capital allocation, anyway, like, assume you are in no role of like, really doing a capital allocation. How does it matter? Okay, so if you look at the last 10 years or last 20 years of your life, so new products emerge and makes your life better, right? Let us take some example, right? Like first of all, computer came. Okay. Before the computer came, even the banks used to have a ledger, okay, to record all the transactions, everything, right? So all the accountants will have a note and tally and all. So then the computer came, right? So computer like was very helpful, which everybody will accept. Computer was like phenomenally made a big impact on the everyone's life. After computer, it was internet. Okay, before internet, like we had nothing. Mail means like physical mail. We send letter through post. But today, nobody sends letter through post. It's an email. So you are like internet came. After internet, your smartphone came. So today, people are talking about artificial intelligence, like EVs, everything. So like you can ask me like what it has to do with this capital markets. There's everything to do with capital markets because for a computer to come or for a smartphone to come, you need a lot of investment, and you need a lot of investment even before for sure this like this investment is going to succeed. You understand, because like for one computer or for one like for one Microsoft or for one like Apple, there would have been so many companies would have gone bust. So what happens with the capital allocation? So this capital allocation helps in identifying the very efficient guys. So that means there will be like 10 guys who would be coming and saying I'll be building a mobile phone, or there'll be like 10 companies who would be saying I'll build a search engine, okay, like compared to Google. But what happens? This capital markets allocates the capital to the most efficient guy, and once the guy wins, right, he gives you a phenomenally good product. Like nowadays, just think how many times you are using Google search, right? Do you even have a count? Just think about it. How that one single product have changed the way the world is working. How that one single product have like kind of increase the efficiency of the whole world, right? Because like whatever you need, like you can just like Google it and find it out. So but how was Google possible? Because like Google had to do a lot of investment, right? Lot of investment even before they started making money. Okay, then if there are no capital markets, assume like like how we were discussing in the beginning. So everybody is very simple, like nobody cares about the cap. Why to complicate? There was no capital market, then there would not have been a company like Google, or not just Google, like earlier automobile companies have come. So people moved from horses to automobiles. That was one of the biggest shifts. So throughout our history, in every point of time for the society to progress, you need a very like innovation, and like execution is very necessary. And like the guys who are doing the innovation and execution in their product development best, right? The capital markets are used to identify those people. Okay, so now I'll come to the last point, similar to so in the second point I was talking about efficient capital allocation, right? So with the capital markets, what happens, right? It's like similar to the Darwin's theory of evolution, right? What does Darwin say? Darwin say we evolve through natural selection, like survival of the fittest. Lot of people feel like that. So that means when any organizations are born, or like same thing, you take an any product idea, anything which is born, right? There is no surety they will win. In fact, like nobody knows which product will win, which product will not win. Okay, so what nature does, if you really look at it, nature builds the organisms are like the living organisms in many distributions, different shapes, different sizes, different colors, with the different like traits. Okay, it builds and it puts in that environment. So whichever like survives and thrives in that environment, right? So that is called natural selection. So the specific set of organisms which survive and thrive, they will pass on to the next generation. Okay, the remaining will perish. So this is called natural selection. So in a capital markets, works in the same way. Whichever player are efficient, the market will select them, people will reward them, they will survive, they will stay for decades. The people who are inefficient, like allocators of capital, people who are not very innovative, people who are not very smart, then the capital market punishes them, kills them. So what happens? The capital market encourages the efficient or like efficiency within the system, and it discourages inefficiency. So by doing so, the capital market really helps in the progress of the society. So I want all of you to really understand this part. So once you understand this part, this is a basic. Now when you have to go and invest, right, the investing will become very very simple for you. So since capital market does that, what you are supposed to do, you are supposed to identify the efficient player available in the market. That means you see 10 banks, you don't know which bank to invest. Technically, you know what? You should find out who is the most efficient. You go, there are like 10 automobile companies, you should go and invest in the company which is the most efficient and which uses the least resources to give the best value addition to the customer. Eventually, that companies will win. And history has so many examples of whatever I'm saying. So this is what the capital market is. I hope I all of you would have found this video useful. So I'm open for feedback. If there is any feedback, please share it with me. Thanks a lot.